studying your last two. I swim with tea when they turned in. The staring down to mute and can learn the pole that sunk he died.
The Temporary Accelerated Investment Incentive Program, often called the AIIP, was introduced to encourage businesses to invest in new capital assets. The idea behind the program is simple. When businesses invest in equipment, expand operations, and contribute to economic growth. To encourage these investments, the government introduced the AIIP, which allows businesses to claim a larger first-year capital cost allowance deduction on eligible capital assets, subject to the applicable tax rules. Let's look at how the program works at a high level. The process begins when the government introduces an investment incentive designed to encourage business spending. Businesses then purchase eligible capital assets that support their operations. If those assets qualify under the AIIP rules, the corporation may claim a larger first-year CC deduction than it would under the regular capital cost allowance system. Because the first-year deduction is larger, the corporation's taxable income is reduced by a greater amount during that year. Lower taxable income often results in lower corporate income tax. With lower taxes to pay, the business may have improved cash flow, giving it more money available to invest in additional equipment, hire employees, expand operations, or improve productivity. In this way, the program is designed to encourage continued investment and business growth. Examples of capital assets that may be eligible include manufacturing machinery, delivery trucks, computer systems, office furniture, and industrial equipment, provided they satisfy the applicable tax rules. It's important to remember that the AIIP is not available simply because an asset was purchased. The asset must meet the eligibility requirements, be placed in the correct CCA class, and the deduction must be calculated correctly on Schedule A. Throughout this chapter, you'll learn how Schedule 8 is used to determine the appropriate capital cost allowance deduction, and how incentive programs such as the AIIP affect those calculations. The most important concept to remember is this. The Temporary Accelerated Investment Incentive Program was introduced to encourage businesses to invest in eligible capital assets by allowing larger first-year capital cost allowance deductions. A larger first-year deduction can reduce taxable income, lower corporate income tax, improve cash flow, and support future business investment, provided the applicable tax rules are satisfied and the deduction is calculated correctly on Schedule 8. Under the regular capital cost allowance system, the cost of a capital asset is generally deducted gradually over a number of years. This means that in the first year after purchasing the asset, the corporation usually receives only a relatively small capital cost allowance deduction, with the remaining deductions claimed in future taxation years. The Temporary Accelerated Investment Incentive Program, or AIIP, changes this timing. Instead of receiving a relatively small deduction in the first year, an eligible corporation may claim a significantly larger first-year capital cost allowance deduction, subject to the applicable tax rules. To understand the difference, imagine two corporations purchasing the exact same piece of manufacturing equipment. The first corporation follows the regular CCA rules. Its first-year deduction is relatively small, so more of the asset's cost remains available to be deducted over future years. The second corporation qualifies for the AIIP. Because of the incentive, it is able to claim a much larger deduction in the first year. As a result, its taxable income for that year is reduced by a greater amount, which may also reduce the amount of corporate income tax payable. One important point is often misunderstood by beginners. The AIIP generally does not increase the total amount of capital cost allowance that can be claimed over the entire life of the asset. Instead, it mainly changes when those deductions are received. Think of it as accelerating the deduction, rather than waiting many years to recover the cost through CCA. The corporation is able to recover a larger portion earlier. This earlier deduction can improve the corporation's cash flow because less tax may be payable during the first year after purchasing the asset. The overall process is straightforward. First, the corporation purchases an eligible capital asset. Next, the tax preparer determines the correct CCA class. Then the preparer reviews whether the asset qualifies for the Temporary Accelerated Investment Incentive Program. If the asset is eligible, the larger first-year CCA deduction is calculated. Finally, the deduction is recorded on Schedule 8 as part of the corporation's capital cost allowance calculation. Remember that eligibility must always be confirmed before claiming the incentive. A common beginner mistake is assuming that the AIIP provides extra deductions that would not otherwise exist. In reality, the program generally changes the timing of the deductions rather than the total amount claimed over the asset's useful tax life. The key concept is simple. The Temporary Accelerated Investment Incentive Program increases the first-year capital cost allowance deduction for eligible assets, allowing businesses to receive tax relief sooner. It primarily accelerates the timing of the deduction, rather than increasing the total capital cost allowance available over the life of the asset, helping improve cash flow while requiring accurate calculation and reporting on Schedule 8. Before claiming the Temporary Accelerated Investment Incentive Program, experienced tax preparers complete a careful review to make sure the corporation qualifies for the incentive and that the capital cost allowance deduction is calculated correctly. The review begins as soon as the corporation purchases a new capital asset. The first question is simple. Is this a capital asset? Only qualifying capital property is included in the capital cost allowance system. Regular operating expenses are treated differently and are not eligible for AIIP. Once the asset has been identified as capital property, the next step is to determine its correct CCA class. Every capital asset belongs to a specific capital cost allowance class, and selecting the correct class is essential because it determines how the asset will be treated for tax purposes. After confirming the CCA class, review whether the asset qualifies for the Temporary Accelerated Investment Incentive Program. Eligibility must always be verified using the applicable tax rules before any enhanced first-year deduction is claimed. If the asset qualifies, calculate the allowable first-year capital cost allowance using the AIIP rules. This larger first-year deduction is then recorded on Schedule 8 as part of the corporation's capital cost allowance calculation. Once Schedule 8 has been completed, update the corporation's fixed asset records. Keeping accurate asset records ensures that future capital cost allowance calculations begin with the correct opening balances and that all deductions can be supported if needed. Before finalizing the return, ask yourself several important questions. Is this a capital asset? Has the correct CCA class been assigned? Does the asset qualify for the Temporary Accelerated Investment Incentive Program? Was the asset acquired during the applicable period for the incentive? Do you have all of the supporting documentation, including purchase invoices and asset records? And has Schedule 8 been completed accurately? To answer these questions, tax preparers typically review purchase invoices, the fixed asset register, Schedule 8, financial statements, the general ledger, tax working papers, and the corporation's T2 return. Completing this review helps prevent errors before the return is filed and ensures that the corporation claims only the deductions to which it is entitled. The most common mistakes occur when the CCA class is incorrect. Eligibility is assumed without verification. or supporting documentation is incomplete. The key rule is easy to remember. Before claiming the temporary accelerated investment incentive program, confirm that the asset qualifies. Determine the correct CCA class. Verify eligibility under the applicable tax rules. Calculate the first-year capital cost allowance accurately. Record the deduction correctly on Schedule A. And maintain complete supporting documentation. Following this review process helps ensure accurate capital cost allowance calculations, reliable tax records, and compliance with the applicable rules, while allowing the corporation to benefit from the AIIP where it is available.